analysis. Budgeting is a tool. It can, like it says, you can have motivation. You can set aside a goal of saving, $5,000. So you budget in a certain amount every month. You hit your $5,000 so you can go to Aruba or wherever. And then that's like the budget is a good motivator. Like, I know I need to control my spending so I can take this trip to Fiji that I really want to go on, or New Zealand, or I don't know, wherever you want to go. People have different, Japan, save up enough money, take the whole world tour. But you budget it, right? So, savings. Growing savings and reducing debt are the two main financial goals for most people. Growing savings can be a short term, like growing a savings account for a specific person, like a down payment on a house or a car, buying a new car without having to finance it, things like that. And you want to take a look at your income and spending habits. You spend more money than you think you do. We all do. You're at the grocery store and you've set aside a certain amount of money that you're going to spend on groceries, and you go through the store and you're hungry. And so when you go there to spend $100, you spend $120. And you think it's not that big a deal. It's $120. I really needed those Oreos. Right? Or, how they put all the candy right there by the register. They do that on purpose because it increases impulse buying. And impulse buying is how you spend more than you plan to. You've got change in your purse, you use it in the vending machine. Or change in your pocket, use it in the vending machine. And you don't keep track of that spending. Yeah, but that's the kind of spending that you don't keep track of. We don't go home and go, oh, I better add that $1.50 candy bar into my budget. It's just whatever, I had a candy bar. And that adds up a lot. If you actually do an analysis and you write down everything that you spend every single day for a month, and I mean everything, if you put a quarter in a gumball machine, you write it down. You would be surprised when you look at that, at how much money you would feel like you wasted. The cash flow analysis is not the budget. Basically, it's figuring out how you're spending your money, how all your money's coming in, like if it's coming in from if you have one job and you do side things and make money, like you have a job and then you babysit and make extra money, or mow lawns and make extra money, or if you sell stuff on eBay or Etsy, or just if you only just have the job and the income. So that's how your money comes in, and then you analyze how it goes out. Because unfortunately, it always goes out, right? Nobody gets a paycheck and just goes, aha, I got my money. I'll just hold on to it. Because you have to eat, and you have to have a place to live, and you have to have, all this stuff. So if you monitor your cash flow, you can change your spending habits, which will help you reach your goals. For example, you can decide that spending $150 a month at Starbucks, because you have to go have a coffee every day, is maybe not the best thing to spend $150 a month on. And that's what the average person that goes to Starbucks every day spends in a month. Even if you go Monday through Friday and you get any kind of a venti anything, and you go every single day.
I think it would be even worse than the diet.
Well, yeah, but we're going to ignore the health consequences. But there are people that do go to a coffee shop every day on their way to work, and some of them go every day at lunch too. They'll go out work on their way to work, and then they'll go again at lunch and get their coffee fix.
Why not just make it coffee at home? That's so much cheaper.
But I'm just saying, like, it's very easy to spend $150 a month on coffee. Or you could buy 2 bags of Starbucks coffee that'll last you the whole month for like $25. You know what I mean? Like, but if they don't think about it, if you don't analyze it, you don't realize how much money is going to these places that you're not thinking about. If you buy a soda in the vending machine every day, that's $1.50 a day. That is $5.50. Well, no, we're only here 4 days. Okay, so that's $3 every 2 days. So it's $6 a week. So it's $25 a month roughly, depending on how many. $25 a month on Coke out of a vending machine. It's those things that you want to analyze in your cash flow analysis to make sure that you can control that kind of spending. Okay, so Dave and Joan want to chart their monthly cash flow. Okay, so we're not going to actually create this spreadsheet. We're just going to talk about what we would need to do. Okay, so you'd have a list of all of your after-tax income. Those would all be your positives. So every income number would be a positive number that you put in your spreadsheet. Your fixed expenses are things that don't change. Your rent is not changing. They don't change your rent every month. They don't change your car payment every month. Your car insurance doesn't change. If you have a flat rate, some places have a flat rate water bill or like trash bill, anything that's a set rate. If you're doing budget billing on your electricity, it'll be a flat rate. If you're not doing budget billing, it'll change. So some things go into the fixed expenses. Some things go into the variable expenses. Food is always going to be a variable expense because the prices of food go up and down all over the place, and the amount of food you eat and what you're in the mood for changes all the time, right? So that will always be variable. Utilities that are metered will be variable unless you're doing budget billing. So the cell phone can go into fixed expenses, but the house phone without unlimited long distance would be maybe variable if you use it. Anybody even have a house phone?
No.
I do.
Never.
Okay. Advice to you if you have children, when you have children. Get the very cheapest house line you can and keep it, because if you call 911 from a cell phone, they don't know where you are. If you call 911 from a house phone, your address comes up. So if your very young child calls 911 and there's an emergency, but can't tell them how to find you, the house line is good. Yeah, so just gotta think of these things. But you can get a really cheap house line for like $10 with no features, and then you just don't use it for anything other than in case there's an emergency, or people can call you. Savings should be considered a fixed expense. You should set a savings goal of a specific amount per month. And if it has to be a small amount to start with, that's okay. You can adjust it later, but you should set a goal, $50 a month, $100 a month. Then if you're able to put more in there, you do, but you make sure you budget or keep, track like this. I have this set goal of this is the minimum amount I'm going to put into savings every month. So on this spreadsheet, what we would have is we would have the income and the fixed expenses and the savings to be a fixed expense. Those would be the same every month. Income's positive, the expenses are negatives, and then the variable expenses would change periodically. So here's an example. So we've got, you can see here they have their total income, they have their fixed expenses, mortgage, car loan, education loan, personal loan, health insurance, life insurance, car insurance, homeowners insurance, cable TV. That's got a zero next to it, so I guess they don't have cable TV, they decided it was too expensive. You've got variable expenses, groceries, dining out, car, fuel, cell phone. Now cell phone, for most people, is probably a fixed expense at this point. Because how many of you guys have the unlimited minutes, unlimited text, right? So you're not paying per minute, so your bill doesn't change, does it? Yeah, so that you could put as a fixed expense. Electricity will change unless you're doing budget billing, in which case it can be fixed. Water will depend if it's a flat rate or a meter rate. apartment complexes charge a flat rate. Houses are always metered. Entertainment savings, debt reduction. Okay, debt reduction category, this is the money that they're paying towards credit cards or other loans to try to pay them down faster. Over here you have non-monthly, these are yearly expenses. So you would take these and you'd divide them by 12 to figure out how much monthly. And then, yeah, so here's non-monthly expenses per year, 12,000. Non-monthly expenses per month, 1,000. So then they take their income and they subtract all of their expenses. Here's their expenses, 5,990, and their monthly cash flow, they have $110 left. And that money can go into savings or further debt reduction, wherever you feel like it's the best place to be. Consumer credit counseling suggests that transportation expenses be between 6 and 20% of your budget, and savings be between 5 and 9%. Personally, I think 20% is a bit high. I think you should try to cap it out at 15. And then if you have, that gives you like that extra 5% for putting away for, you know, rainy day stuff. Okay, so we're going to use Dave and Jones cash flow analysis, and we're going to determine if they remain within the guidelines or not. So we need to go back, and their income is $6,100. Okay, transportation expenses. That includes the insurance, the car loan payment, and fuel. Just making sure they don't have like parking or anything on here. Okay, so 260 and 160. Okay, and then their savings is 300. Okay, so we need to decide if they're within their 6 to 20% of their budget. So we're going to take 6% is 0.06, 20% is 0.2. And we'll multiply that times their income. Okay, so that would be $366. This would be $1,220. They're at $420, which is in between the 6 and 20%, so that's good. Now, do you see why I said 20% seems kind of high? That would be like a large car payment and a lot of gas money. You know, I mean, that's a lot of money to spend on your car in a month. Savings, it said it should be between 5 and 9%. So 5% is 0.05, 9% is 0.09. We're going to do 0.05 times 6,100 and 0.09 times 6,100. So this is 305. And that's 549. And they're over here with 300. So they're good on their car payment, but they're not good on their savings. So what they should do is they should take some of that monthly cash flow left over that they have and bump it into savings to increase that percentage that they're hitting. Okay, your net worth is the difference between your assets and your liabilities. Okay, assets are things you own that have value. So, the flip-flops I am wearing on my feet right now are not an asset. I own them, but they have no value to anyone other than me because nobody wants my old, worn, nasty flip-flops, right? I mean, nobody wants your old shoes. Things that would be considered assets are your car, if it's paid off, or if you've paid more than, like if you owe less than it's worth. Your home, jewelry, electronics, anything that has a resale value would be an asset. Liabilities are not your monthly bills, but your debt. So loans, credit cards, things of that nature. Your electric bill is not considered to be a liability. That's not a debt, that's just a monthly bill. Does that make sense? Okay, so if you have this person has their condo, has their car, they have money in the checking account, money in your bank is an asset. Stocks, bonds, those are assets. We've got computer, guitar, stocks and bonds. So anything like with retail value, like I said. And then his liabilities are his mortgage, what he still owes on it, the student loans, the credit card debt, and that's it. Okay, so first we're going to add the assets. Okay, so when we total those, we get that his, no, that's not right. Oh, darn it. I see what I did. Hold on. Okay, now that I entered it correctly, those are his assets. And then we total the liabilities. 380,000 plus 51,000 plus 1,600. Okay, now to find his net worth, we take his assets and we subtract the liabilities. So assets minus liabilities. And it's always assets minus liabilities. If your liabilities are greater than your assets, you have a negative net worth. Okay, so his net worth is 240,580. Okay, last year he had calculated at 205,780, and how it changed? Well, the whole year he was paying on his mortgage. He was probably paying on his student loan. Yeah, he was paying on his student loans, and maybe he was paying down his credit cards. So your net worth can fluctuate based on your spending and your, like, spending as in buying new debt, like taking out new loans and things like that, new credit card bills, new purchases on credit cards. That can lower your net worth. But paying on your mortgage, paying on your car loans, paying on your student loans, that all increases your net worth. Net worth is one of the calculations that banks consider when they're taking into account whether or not to give you a loan. Any questions on this one? Okay. Debt reduction. There's different ways you can do debt reduction plans. You can either come up with some plans on your own and work on them, like paying a little bit more. So let's say your mortgage is $530 a month. Pay $600 if you can afford it. Pay $550. It lowers your interest. It lowers your overall balance on your mortgage more quickly. Even a small amount can make a difference over time. Then there are other things where you can go and go to a credit counseling service. they'll call your credit card companies and things and like haggle with them. Now the accounts end up closed. You wouldn't be able to use them anymore. So like you got a Visa that you wanted to reduce the debt on. They close the account, but you're paying 21% now. The credit company might be able to talk them down to like 6 or 7%, which greatly reduces the amount of money. Now you can't use the credit card anymore, but you'll reduce your debt. So that's what the credit counseling services do. They make these arrangements. They haggle with your creditors to bring down your interest rates. So debt reduction can be found, like, I mean, if you go on Google and type in debt reduction, there's probably a Google worth of sites. I mean, there's just that many. Lower the debts that have the highest interest rates. These are typically your credit cards, so pay those off or try to negotiate for a lower rate. Pay more than the minimum amount due. If your minimum payment is $25, even paying $30 will make a difference. You know, even if you can increase those minimum payments by $5 or $10, it helps. Look for ways to cut costs daily. Well, we were just talking about how easy it is to not think about, like, when you buy the soda or candy bar or whatever, it's really easy to spend that money. Well, if you do the cash flow analysis and you realize how much money you're spending on those little things and you change your spending there, you can take that money that you're wasting on Starbucks coffee or whoever's coffee and put it towards your debt and pay those, or put it towards your savings to reach your goals faster, you know. Online debt management calculators, these are free. There's a ton of them. Here's the big thing. See this right here, face your debt. A lot of people that get into trouble with debt have collections, like they didn't pay their bills for whatever reason, it got sent to a collection agency. They get the notices in the mail and they're unable to deal with it, so they throw them in the trash or stick them in a drawer, and they build up and build up and build up and build up. And the reality is while those people, like the collection people, are rude, if they have to call you up and like you're not paying, they get really rude because that's their job. They're supposed to be rude. But if you call them and you say, hey, I got this notification in the mail, it says I owe $650. I don't have $650. And can we make a payment arrangement? And then they'll come back with, well, can you pay $100 a month? You'll be like, no. And you look at your budget, you said, look, I worked out my whole budget, I worked out my debt, I have like 6 of you people to call, I can give you each $25 a month. They'll take it. You know why they'll take it? Because $25 a month is better than the no dollars a month they're going to get if you don't pay, if you stick it in a drawer, if they're not willing to work with you. So they're willing to work with you. They'll probably go, well, I can't take $25, how about $75? And you just have to go, nope, I can give you $25. No, we can't take $25, I can give you $25. So there's things like that, but you need to face it. Those people on that video that we watched where they like got so badly in debt and then they ended up like committing suicide and stuff, it's because they weren't proactive. They didn't face it. They just let it build and build and build and build, and it gets worse and worse and worse and worse. Also, if you work with a credit counseling company, they can eliminate new interest. So if you have a bunch of credit cards that you can't afford to pay the bill on anymore for whatever reason, I don't know, like you broke your leg and lost your job, happens. You can call the credit card or the credit consumer counseling people, and they'll talk to the credit card, and they stop new interest from accruing. So whatever the balance is that day, that's the balance. You just don't keep building interest. So it's just better. And slow down or eliminate your credit card spending. Some things are okay to finance. You get a brand new job and you need work clothes and you don't have the money to go buy like business professional attire because you just graduated college. Okay, go ahead and buy a bunch of clothes on the credit card and then pay them off over time. Don't use the credit card anymore until you pay it off. You need a new car? Go ahead, finance it. You need new furniture for your brand new house that you just got because you just graduated college and you just got your brand new job and you had to move to another city and you have no furniture. Okay, get one of those installment plans. Sure. Don't use your credit card at Burger King. Do not pay interest on a Whopper. Please don't. It's not worth it. A Whopper is not worth it. How much is a Whopper? I don't eat at those places.
Probably like $2.
$2 or $3? It's not worth $3 anyway. If you finance a Whopper for 2 or 3 months, you're paying like $7 or $8 or $9 or $10 for a Whopper. If you want a $10 burger, go to a nice restaurant. You know what I mean? Like just be really careful where you use your credit cards. Does it make sense? I mean, like, think of it that way. Like, do I want to pay interest on this? Then you'll go, no, I don't want to pay interest on French fries.
90% of the time, it's probably you don't want to pay interest, period.
Right, that's what I mean. But like, if you think about like large purchases that you have to buy, you know, bedroom furniture for your new place and you don't have any money, okay, fine, use an installment plan. Sometimes it's worth paying interest to be able to have the things that you need. But paying interest on things like fast food and groceries is not really smart. You know, just keep these things in mind. That's all. I'm not saying credit cards are evil or that you should never go into debt because I think that's impossible. But, you know, just make sure you go into the right kind of debt. Okay, your debt to income ratio. Oh, I didn't go over this. I'm sorry. Do you see here where it says 15 and under is recommended? Okay, debt to income. So you're going to divide your debt by your income. And this is monthly. So not your total amount of debt by your your income, because that would like your monthly payments on your debt. So if you have like a mortgage for $100,000, you wouldn't put that whole $100,000 in there and then divide it by your monthly income. That would be a little bit. That would be an insane percentage, right? But your monthly mortgage payment you would put on there. So let's say. Well, you want a 15% and under ratio. Let's say you have a car payment, let's say, and you have a mortgage, and you have credit card payment, like that or something, and student loans. We'll just say student loans. Okay. And let's say you have an income of, how much money you guys want to say your income is per month? $45? We'll go with 45. That would be 36%. And now it's just a car payment and a mortgage and credit cards. The credit cards are a bit high. The student loan will go away eventually. If we took out the credit card, it would be down to $1,525. No, sorry. Yeah, $1,500. And that would bring you down to 33%. You know, I mean, but see here, I would say, okay, I have to eliminate this. Maybe I need a cheaper car. You know? Make sense? Okay. You want to keep it below 15% if possible. So let's look at this one. We've got a mortgage payment, a student loan payment, a credit card payment, a car loan payment. We'll add all those together. They've got $3,400 in debt, and then their income is $8,300. So we put the 3,400 and we divide it by the 8,300. And they are way off. This person really needs to reduce their debt. Because this debt, this monthly liabilities, this debt does not include your electric bill and your phone bill and your water bill and your food bill and your gas for your car insurance, homeowner's insurance. And they're spending 40% of their income just on debt. Doesn't allow much room for a lot of other stuff. 40% is almost half, right? For you.